Hello and welcome. My name is Mark Illingworth from Family Retreats UK Limited. Today I'm going to talk to you about tax efficiency in property in the area of income tax. My previous video I talked about good debt and bad debt, and if you haven't seen that, I would recommend you pause this video and go and watch it because it does have some relevance in what I'm about to explain to you. So for easy viewing, I have tried to cut these videos down into bite-sized chunks. There are three main taxes when it comes to property. In this video, I'm going to talk to you about income tax efficiency. If I was explaining this to a group of people in a pub or a room, I would pick out two names in the room and use those. But for the sake of this video, we're just going to say Nick and Dave. Okay, so Nick and Dave run identical lives. They have the same job, they have the same income, and they buy the exact same identical house for the same money, as you see here, £90,000. And they both get the same 75% mortgage. Interest rate 4.5%, which would probably give our right arm right now for a 4.5% mortgage. But they both rent out the house the same. So you can see there they're getting a rental income of £650 a month. Have all the same costs, leaving them both with identical £219 profit per month. Now Dave, over the last 20-30 years, has been totally educated in debt is bad and he can't help himself. He pays off the mortgage completely off over the next sort of 15 years. Whilst Nick, he listens to my rules and he gets an interest-only mortgage and does not pay any of his debt off at all. So what's the reward for Dave paying off all the mortgage? So firstly, he has to find £67,500 from somewhere, probably his job, to pay off the mortgage. Whilst Nick hasn't had to do that. Instead, he's probably been spending his money, having a great life, having lots of parties, or if he's sensible, he would have used that money and gone off and bought another property. So what was the other reward David got? Because the first one wasn't really a reward, was it? Because Dave has paid off the mortgage down to zero, the revenue are going to come to him and say, congratulations, you are making an extra £250 profit. And because you're a 40% taxpayer, we are going to charge you an extra £100 a month in tax. Now Dave and Nick still have the same identical properties. They still have the same jobs, the same identical income coming in and the same rent coming in and overheads. But because Dave has paid his mortgage off, we're going to charge, in the revenue, we're going to charge him an extra £100 a month in tax. So if you pay off those mortgages, you will pay more tax. So let's just take a look at Nick for a minute. Now, he has another problem. Because he's been listening to what we educate, and that is making sure you put your rents up every year at least by 3 to 5%. So because of this, Nick is getting an extra £60–70 a month dropping onto his bottom line as profit and will pay more tax. Also, some of his costs have gone up, which will help cover the increase in profit. But inflation has made the rents go up. But what else goes up with inflation? Yes, the property value will have also increased. So with that in mind, Nick can go back to the bank and borrow 75% of the new value. So let's say the property goes up 10%. Nick gets another mortgage at £74,250. Paying off the original, which will leave him just short of £7,000 tax free to do what he wants with. Hopefully put that towards another property. Now the bank puts his monthly payments up But that's fine because he's been increasing his rent so he can afford it. But the important thing is Nick remains tax efficient. Does that make sense? So thank you for watching. Watch out for the next video where I will be covering capital gains and inheritance tax. Or if you can't wait, go onto the YouTube channel down below here and watch them now. So grow your knowledge, build your confidence, invest and grow your financial freedom. Thank you and speak to you soon.